Books Online 2025 Balance Sheet Vertical Analysis Report. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody, looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to go ahead and choose the United States version of the software, verify that we're not a robot or else they won't let us in the door. And we want in the door, we want to be working with the practice file here. So we're going to go ahead and leave our robot friends out in the cold just so we can go in here and practice our QuickBooks sample company file, Craig's Design and Landscaping Services. We're going to open up the reports as we do every time. The reports, they're on the left-hand side. We're in the Standard tab under the Favorites. Right-clicking on that balance sheet to open a link in a new tab. Or right-clicking the P&L, the Profit and Loss, sometimes called the Income Statement, to open the link in the new tab. Let's go to that middle tab. Close up the ham boogie, do the range change as is our custom 010124 tab 123125 2-year time frame. I want to see it in years and run it. And then let's go to 2025 or the income statement to the tab to the right. Close the hamburger and then range change it from 010124 tab 123125. I want to see this in years as well. Run it to refresh it, remembering that QuickBooks might be currently populating the information from 2024 to 2025. So whenever you're watching this, you want to choose the time frame that has the current data in it as we practice generating our reports. We're going to be using these as our baseline reports, opening up another report for the balance sheet to practice the customization to make what I would call a vertical analysis type of report. Let's go to the first tab to do that and go back to the reports again. And we're going to be opening up another balance sheet, remembering that sometimes QuickBooks will create multiple balance sheets like we saw before, like the comparative balance sheet, which basically can be generated through the customization. We want to learn how to do the customization, a vertical analysis being very common as well, possibly more common, however, on the performance reports like the income statement or P&L profit and loss than the balance sheet, but can also be used on the balance sheet. Let's check it out, let's see what it looks like. Right-click it on that balance sheet, open a link in a new tab. Let's go to this balance sheet on the right. I think most of the data currently is still in the year of 2024, so that's going to be the year that I choose to work with. Let's close the ham boogie. Let's change the range. 010124 tab, 123124 tab, and then I'm going to keep it in totals for this report and run it. Now, in prior presentations, we thought about comparative type reports, which under the classic view is located here. And we have this type of comparison. And we also saw that we can make a comparison of period to period using this functionality over here. We also saw, as we did the comparison, this percentage change. This is what you might call a horizontal analysis because we're comparing horizontally across a row from period to period. Now we're going to do what we might think of as a vertical analysis type of system, in which case I want to see the percentages, but not comparing the change from one time period to another time period, but comparing items within one column that are totaling up to the total of that column. Therefore, we're going to choose the percent of the column. Where's the 4? Where's the 4? Therefore, I see it. I see the 4. Therefore, we're going to do a percent of a column. All right, so I'm going to click off of that and run it. Now, notice if I was in a modern view, switch to modern view, where is this located? It's going to be under the comparative items. And then if I go down to the calculations, it's under this percent of column, just so you know, and then we could refresh it here. And that's how it looks now. So we don't know which view they're going to be settling down on. We'll practice them both as we go. So I'm going to go back to the classic view here, and there's our basic classic vertical analysis type of situation. Now, what are we doing here on a vertical analysis? Let's do a little bit of an analysis of the vertical analysis, and that is that we're comparing everything to the total, remembering that for the balance sheet, we don't have a performance type of report. Our objective for our accounting is to generate revenue. On the balance sheet, what do we have on the total? We've got total assets equal total liabilities and equity. So therefore, it would make sense from a vertical analysis standpoint to compare each line item of the assets to the total assets, which are equivalent to the liabilities and equity. If we pull out the trusty calculator to see what that looks like, we could say the checking account, for example, or we could say the bank account's total comes out to the 2642.32 divided by the total for total assets, which is kind of like the bottom line, right? 23095.96. And that's going to give us about 11.44%. So that means that the checking account accounts for about 11.44%, 11% about of our total assets. Why might this be useful? Well, on the balance sheet side of things, we might want to compare to prior periods or other companies. If I'm comparing my landscaping business to, say, the benchmark or the biggest and best landscaping business, they might have more revenue, they might have more cash than we do, they might have more everything than we do, right? They just have bigger numbers. So how can we do the comparison? How can we benchmark? How can we try to copy what they're doing so that we can see that if we're at least as efficient as they are with the assets that we are using? We could say, well, look, how much cash do they hold on to compared to their total assets? We could say, for example, how much property, plant, and equipment do they have in comparison to their total assets, for example. So here's the PP&L, the truck. We have the 13,496 divided by the total 23,095.96. That gives us about 58%. Noting some industries are going to have a lot more, property, plants, and equipment, for example, versus other types of businesses. So for example, if we're just a YouTuber, we're just doing the gig work and whatnot, then we're probably not holding on to a lot of property, plants, and equipment. We've got the microphone, we've got, our computer, we've got some stuff there for sure, but for the most part, we don't need a whole lot. And that note means that there's not a big barrier to entry, and therefore you're going to have more competition typically. That's the way it basically works. Whereas other industries such as manufacturing or farming or something like that is going to take, or construction, that's going to take a huge initial investment to get the land, to get the equipment, and so on and so forth. And therefore there's going to be a constant struggle not only to have a lot of assets to try to generate your assets, but to have the liquid assets in order to pay off the current bills, meaning it's going to be quite possible for us to have a net assets that's quite high, assets minus liabilities, but still possibly not a lot of cash because all of the assets that we have, all the cash is invested in property, plant, and equipment. On the plus side, however, with these big or capital investment intensive companies, you're not going to have as much competition because there's a huge barrier to entry not imposed by the government per se, although you have that as well, and you can have the government kind of colluding. You could see big businesses actually colluding with the government to do things that look like they're going to be contrary to the business's interest when actually they are in alignment with the business's interest. Why? Because although it costs them more, it's a huge barrier to entry to everybody else, right? But that's the idea. So that's going to be kind of the trade-off, and we could look at a particular industry and see the pros and cons and try to compare on a percentage basis. Similarly with liabilities, we can compare our liabilities compared to the total liabilities and equity. So this gets into kind of like ratio analysis when we're thinking about the balance sheet. So for example, we might take our long-term liabilities, which are our loans, and say we have 25,000 there divided by the total liabilities and equity, which equals the assets divided by the 23095.96, and we've got the long-term portion of the loan, Wait, this is total liabilities. Did I do that right? 20. Yeah, the long-term liabilities are greater than our total liabilities and equity, which is interesting. We could also compare total equity, which is actually a negative number here, right? So now we have a negative number in the equity. So that's going to get into some kind of like ratio analysis, but remember that the liabilities and the equity represents how we're financing the assets. Where are the assets that we have coming from? How are they being financed? Either we, the owner, are putting money into the company that we then use to purchase the assets in order to help to generate us revenue, or we took out a loan to get that initial investment, and or as the company is proceeding forward, we will hopefully be generating revenue, and the revenue will be retained earnings, rolling into retained earnings, helping us to hopefully finance the business. Now, obviously, there is no retained earnings right now because the only data in the current system is for 2024. Therefore, we have a limited amount of net income and a negative amount for the opening balance. So we haven't like recovered the amount of the initial investment that basically went in would be kind of the idea here. But that's the general idea. Now, just a quick comparison. We'll take a look at the income statement later, but let's just do a quick comparison on the income statement. If you were to do a vertical analysis with the income statement, selecting the drop down, for example, you would typically do a comparison to the income line item, not to the bottom line item. And that's a little bit confusing, but remember that revenue is what we're trying to do here. So we're trying to generate revenue. So what I want to do on the income statement is compare everything that we have, the expenses that we consumed, as well as the different categories of revenue to total revenue, which is the objective or goal of the business. So just vertical analysis on the income statement will typically be for a percent of income. And so notice you have a few different choices on the income statement. We have 2 periods here and then the total. But if we just look at the total here on the income side of things, you can see that total income is 100%. So that means we're just comparing the income line items of each line. And then on the expenses, it's being compared to total income up top. Whereas on the balance sheet, we're comparing to total liabilities and equity, which makes sense from the asset perspective. You might also compare this, for example, if you have finance experience, you deal with investments, and you're trying to benchmark how to invest, you might try to copy, say, the same percentage investment of a famous investor like Warren Buffett or something like that, and say how much of his money is in stocks versus bonds, and then break it down further, possibly into regions of the world and so on and so forth. In which case, you can't, how could you copy someone like a Warren Buffett in their investment strategy? You don't have the same amount of money. I can't put the same amount of dollars in, but I could try to think about the percentage allocations and think if I can do a similar kind of percentage allocation in stocks versus bonds versus whatever locations and so on, companies, individual companies possibly. So that's going to be the general idea here. Now, once again, the headings up top might not be exactly right because I might want to call this something other than just a balance sheet. Maybe I want to call it a vertical analysis balance sheet or something like that. Maybe I don't want, the date might be fine here. Maybe I want negative numbers to have brackets around them. Maybe I want to remove the pennies. Maybe I don't want this information on the bottom. So we could then customize this. If we go to the customize in the classic view, we have this up top, divide by 1,000, no, but I could remove the pennies. I could make negative numbers bracketed and red, which is what I commonly do as a general customization. We don't have a lot of other customization like fonts or different colors, which again, we could get if we exported to Excel to do a little bit more customization, and that could allow you to stand out doing stuff that other people aren't doing, right? And then we could go into the headers and footers and say we could add our logo if we wanted to, company name, report title. Maybe we want balance sheet vertical analysis, which I'll probably spell wrong. Vertical analysis. Yeah, that's just horrible. Vertical analysis. For crying out loud. What is English your second language? Okay. back off, man. Spelling's, you don't need to spell anymore. You got this, the spell check is everywhere. Report period, so we can remove possibly, well, I'll keep the report period, date paired, time prepared on the footer, remove that, boom. And so now we've got a little bit cleaner, maybe for external reporting. There's our negative numbers, nothing's on the footer. By the way, if you wanted to see that in the modern view, where would that be located? Let's switch it to the modern view. And we saw our comparison information here in the dropdown, percent of column. And then in the general options, we have the round amounts to the nearest. That's the remove the pennies, negative numbers bracketed and red. And then we have header and footer. We have report period is there, company name is there. And then on the footer, I got rid of the date prepared and time prepared for the footer on down below. And so that's the two views currently in practice. Let's switch back to the classic view. That's going to be the general idea. Now, once you have that, if you want this to be part of your stock or standard procedure for month-end reporting that you then put in a package and give to a client, you might then customize the report, or I'm sorry, save customize of the report, maybe add a group for month-end reports or something like that, or external reports, adding that as the group. And then I got balance sheet vertical analysis, save it. And then when I go back into the reports, I can go to the reports down below, customize, and now I've got my balance sheet vertical analysis. All I should have to do is change the date range, and hopefully the formatting will be properly put in place. So let's go back to the balance sheet. Notice how many different report settings we could have, even when just thinking about the major financial statement reports, of which we've only looked at the balance sheet, but also have the income statement. We now have comparative reports comparing multiple periods, like more than two, like months, years, and so on. We then have comparative reports with just two periods, which we can then take the difference and the percent difference, horizontal analysis, percent increase or decrease over a period, which we can compare one month to another month, the current month like December to prior month December, one quarter to another quarter, the current quarter like fourth quarter to the prior fourth quarter, for example. And now we have the vertical analysis, where we can basically do an analysis percentage vertical wise, comparing to the total. And you could do that for multiple periods as well. So maybe I wanted to do it for 2 periods. Now, instead of using this method of looking at the prior period, this is what we would do if I wanted to take the difference of the 2 periods. If I want to take a vertical analysis of 2 periods, then I can do it this way, right? I can change this to 2024 to say 2025, and then change this to years and run it. And so now I've got the current period and the vertical analysis for it, for 2024 and then 2025, and then the vertical analysis for it. And of course, we could do more than 2 periods. We could do it on a monthly basis and run it. And now we've got the vertical analysis applied out to each month. There's no activity in this particular statement, but there they are. And you can get quite complex reports. So some of the questions will come up then. For example, you might say, if I'm giving these reports to someone else, do I want a simplified balance sheet, like a summary balance sheet, or do I just give them the standard balance sheet? And then if I give them a balance sheet, what if I add the vertical analysis to it? Should I give them a summary balance sheet and then a standard balance sheet and then add the vertical analysis, which is really just adding another column? Or should I just give them the balance sheet with the vertical analysis, which is more complex looking, but it gives them more information? Or I could just give them one that has a comparative balance sheet, last year versus this year, both of them having a vertical analysis in it, right? Which means you're getting an uglier looking report because it's got more detail in it, but it has more detail in it. So these are questions that you can come up to. How much data is too redundant? How simplified a report do you want so that you can have a presentation, for example, possibly giving things as easily as possible, as clean as possible, hopefully drawing people in so that you can maybe then drill down on further data. These are things to keep in mind as you're trying to put together your presentation or package that you're going to be giving to a client, remembering that clients usually oftentimes aren't accountants, and therefore you're going to try to give them the information in the way that you think is most useful to them to try to communicate what you think you need to communicate and give them confidence that you're going to be there at least when they need you, which is typically going to be at the end of the year for tax preparation, external reporting, working with the CPA firm, and so on, or doing the taxes yourself, or whatever is going to be happening at that time.